Most investors believe they understand drawdowns, they have seen the charts, they have read the statistics, they know markets fluctuate. But knowing something statistically is not the same as tolerating it psychologically. And the difference between those two states determines whether someone compounds wealth or self-destructs mid-cycle. A drawdown is simply a decline from a previous peak. Mathematically, it is neutral. Psychologically, it is destabilizing because the human brain does not experience losses as percentages. It experiences them as threats. Daniel Kahneman and Amos Tversky, through prospect theory in 1979, demonstrated that losses are felt roughly twice as intensely as equivalent gains. This asymmetry, loss aversion, is not minor. It changes decision-making under stress. If a portfolio gains 10%, the pleasure is modest. If it loses 10%, the discomfort is disproportionately larger. But what most people miss is that loss aversion compounds during drawdowns. Because drawdowns are not single losses. They are sequences of losses, and sequential losses trigger escalation in stress response. Neuroscience research shows that repeated financial loss activates the amygdala, the brain's threat detection center. Elevated cortisol levels impair executive function. Under stress, the prefrontal cortex, responsible for rational planning, becomes less dominant. This means that during drawdowns, your brain is biologically less capable of making long-term decisions. The system shifts from optimization to survival. This is adaptive in physical danger. It is destructive in probabilistic environments. Let's examine history. Since 1928, the S&P 500 has experienced a drawdown of more than 10% roughly once every 1 to 2 years. A drawdown of more than 20% roughly every 4 to 6 years. Multiple drawdowns exceeding 30%. The Great Depression saw declines exceeding 80%. The 2000 to 2002 dot-com crash saw the NASDAQ fall approximately 78%. The global financial crisis in 2008 saw major indices fall over 50%. The COVID crash in 2020 saw markets drop over 30% in a matter of weeks. Each event felt unprecedented. Each event felt catastrophic in real time. Each event triggered narratives of structural collapse. And yet long-term capital markets continued functioning. The issue was never volatility, it was endurance. Dalbar's long-term studies on investor behavior reveal something critical. The average equity fund investor consistently underperforms the funds they invest in, not because the funds fail, but because investors enter and exit at emotionally extreme moments. They buy after strong performance, they sell after sharp declines, they time their decisions based on emotional intensity. Drawdowns are where this behavioral gap widens most. Investors often exit near bottoms, not because they lack intelligence, but because discomfort peaks. Why does discomfort peak near bottoms? Because volatility expands when uncertainty is highest, and uncertainty collapses time horizons. Research on recency bias demonstrates that individuals overweight recent information when forecasting the future. During a prolonged drawdown, recent losses dominate perception. It becomes cognitively difficult to imagine recovery, even when historical data strongly supports it. This is known as availability bias. Vivid, emotionally charged events override statistical reasoning. Another distortion during drawdowns is what psychologists call myopic loss aversion. Studies by Benartzi and Thaler show that when investors evaluate portfolios more frequently, they perceive risk as higher. The more often you look, the more volatility you observe. The more volatility you observe, the more risk you feel. The more risk you feel, the more likely you are to reduce exposure. Drawdowns increase monitoring behavior. Monitoring increases perceived risk. Perceived risk increases anxiety. Anxiety increases impulsive action. This feedback loop is powerful. Let's discuss compounding mathematics. A 50% drawdown requires a 100% return to break even. Mathematically, large drawdowns are asymmetrically damaging, but here's the nuance. Most long-term investors do not experience catastrophic drawdowns because of volatility alone. They experience them because of behavioral amplification. They increase exposure late cycle, they use leverage, they concentrate portfolios, they ignore diversification. When volatility arrives, damage is magnified. The drawdown is not purely market-driven, it is structure-driven. Drawdowns also distort identity. And if your self-concept includes being financially competent, consistent losses create identity threat. Research in cognitive dissonance shows that when reality conflicts with self-image, people distort interpretation to preserve identity. In markets, this leads to two common reactions. Denial. This is temporary noise. Capitulation. I clearly can't do this. Both are extreme. Both are emotional. Both ignore probabilistic framing. Another overlooked effect is time horizon compression. During stable periods, investors claim to be long-term. During drawdowns, they behave short-term. Why? Because uncertainty increases perceived urgency, and urgency narrows perspective. Studies on stress and decision-making show that acute stress reduces long-term planning capacity. This is measurable neurologically. Under high stress, individuals discount future rewards more heavily. In other words, drawdowns biologically shorten patience. Now let's address an uncomfortable truth. Drawdowns are not anomalies. They are structural features of markets. Markets are not linear growth machines. They are adaptive, cyclical systems with volatility clustering. Benoit Mandelbrot demonstrated that financial markets exhibit fat tails and clustered volatility. This means extreme movements are more common than normal distributions predict. If your mental model assumes smooth returns, drawdowns will feel catastrophic. If your model assumes turbulence, drawdowns feel statistical. Expectation shapes reaction. Professional risk managers treat drawdowns differently. They define maximum drawdown tolerance in advance. They stress test portfolios using historical crisis data. They simulate worst-case environments. They define capital at risk explicitly. They size positions so that emotional tolerance aligns with financial exposure. Retail investors often do the opposite. They define returns precisely. They define downside vaguely, and vagueness collapses under pressure. Let's be precise. There are two types of drawdowns: structural drawdowns, market-wide repricing events, thesis invalidating drawdowns, asset-specific deterioration. Confusing them is costly. Selling during structural volatility often locks in losses. Holding during thesis invalidation compounds damage. Distinguishing between the two requires predefined criteria, not emotional judgment. So what does survival look like? First, assume drawdowns are inevitable, not rare, not abnormal, inevitable. Second, define position size relative to emotional tolerance. If a 15% decline causes panic, the allocation is too large. Third, reduce monitoring frequency during volatility spikes. More observation increases stress without improving outcome. Fourth, maintain liquidity buffers. Forced selling during drawdowns is often the true destroyer of compounding. Fifth, measure risk-adjusted return, not peak value. Peak value is ego-driven. Risk-adjusted stability is structural. There is a powerful concept in investing. The investor rarely loses because markets fall. They lose because they break during the fall. The portfolio breaks second. The psychology breaks first. Drawdowns do not destroy investors. Behavior during drawdowns does. If you remember three things from this video. First, drawdowns distort perception more than they destroy value. Second, emotional tolerance, not intelligence, determines survival. Third, structure before volatility preserves discipline during volatility. Markets will test you, not once, repeatedly. And whether you compound or capitulate depends less on analysis and more on whether you can endure the psychological weight of temporary decline.